We are now going to continue our conversation that Paul kicked us off with around creating positive stakeholder value, but from the perspective of private equity. I will be joined by a panel of industry veterans in private equity who are committed to creating positive societal impact. It is my pleasure to introduce Brandon Brahm, partner at KKR, Christopher Rowe, managing director, investments at Church Pension Group, Tazia Smith, COO and head of capital partnerships at Closed Loop Partners, and Serge Younes, head of sustainability at Investindustrial. Welcome, everybody. It's great to have you join us here today. So we're going to talk about private equity. So as we discussed briefly yesterday, private equity is a real force in economies globally to the tune of about 7 trillion. And then in the United States, where they generate 1.4 trillion in GDP and control close to 12 million jobs. Working with partners such as the Predistribution Initiative and the United Nations Principles for Responsible Investment for Private Equity, we have begun a research initiative to develop a responsible investing framework for private equity, one that creates a pathway for responsible growth that ensures equitable allocation of capital to all stakeholders. Please visit our website for more information and let us know if you'd like to be involved in this initiative. In the meantime, I am pleased to host a panel with some of the innovators in the space, 3 from private equity and 1 from an institutional investor who invests in private equity, so we get all perspectives. So welcome all. Great to have you join us. We have about 1,200 people signed up for this, investors and sustainability leaders. So I'm really looking forward to this conversation. My first question is focused on the private equity firms. And let's start with you, Serge. And this question will be the same for all 3 of you. Please share with us how your firm approaches ESG, or environmental, social, and governance issues, and creating sustainable value with your portfolio companies. Please explain your approach at the firm level, and then if you can, provide an example of how that is translated to actions taken by one of your portfolio companies so you can bring it to life for us. Thanks, Serge.
Thank you, Tensie. Big challenge in 3 minutes to answer all that. Well, actually, as Paul Pullman was saying in the earlier session, I think we're smart enough as investors to realize that there's actually value in that. I think there was decades of it being anecdotes and us wanting to do good, but not really being able to measure it. And that forced us to kind of restructure the way that we do things, that we are able to trace. And I'm sure we'll get to that a little bit later in terms of how do you actually measure value creation at the end. It all starts for us in due diligence when we have an idea about an investment and we kind of run through it. And what we find is our ability to get in, roll up our sleeves, get engaged in the process. And it's not just a desktop exercise, it's actually going on sites. Investindustrial is a mid-cap PE that invests a lot in industrial companies. You want to know what you're buying, you want to understand the issues, you want to understand the culture of management, you want to know how things operate to be able to create that value. And ESG is a central core part of that. We then developed a 3-year plan that is standard for all our companies. And then within kind of in between the due diligence and getting to the implementation of that standard 3-year plan, we have a bespoke 18-month kind of, we call it the 100-day plan that generally drags into a year and a half. And we have a big shopping list of things that we believe the company should do to create value. We invest primarily often in companies that have zero maturity on sustainability. We do not discount them when we actually see that there's a value case and we have appetite from the management teams to go and execute on a sustainability plan alongside all the other plans that we have for the company to execute on. So it takes us, I've had too many conversations where, you go and you do an onboarding session with the management team and they're talking to you about, their recycling bins and how they got rid of plastic bottles. And you're like, okay, we need to move that discourse very quickly in matter of weeks or months into how is this going to be core to the business? How are we going to derive new revenues from that business? How do we bring it into operational excellence, looking at supply chains, looking at everything that you do in your operations to streamline it. And ultimately we are numbers people. And the anecdotes of we did this or we planted trees or we got did some recycling here and there needs to ultimately come down to how did we affect EBITDA? How did we transform that business from a view of we're minimizing harm to actually we're doing good and we're driving revenue from that, and there's a customer need from that? That all translates into real dollar signs, and this is what we're into. Ultimately, we come in, we have a horizon of the next 10, 15 years. We're going to start a transformation journey. Somebody on the other side, whether it's Brandon or somebody else here, will probably take it for the next 5 years, and we need to think about whoever's going to buy it from them. So there's a continuity in, when we say private equity is a long-term investor, it's not just our holding period, which could be 5 to 7 or 10 years. It's the next one and the next one. And sustainability is one of those great things where we are not in competition with one another. Actually, it's one of the rare areas in private equity and investment management in general where we're collaborating, working together to that final goal, because we're all in this going the same direction. You wanted an example of a company. We have great little gem that we bought quite a few years ago, a business that is in plastic compounding, and you're going to all say, hidden gem, plastics. And that was the argument that we had in the beginning. Plastics, what do we do with plastics? Is it the right investment or not? But ultimately, in that particular case, in the investment thesis here, we realized that all the fundamentals to do the transformation into bioplastics and recycled plastics exist in normal plastic compounders from fossil fuels. And the investment thesis worked through, what do we need to do to start that transformation going? Obviously, there's a lot of stuff in terms of housekeeping. It's a company that was carved out from a business who was carved out from a business. They didn't have all the policies and procedures and so on. All that needed to be built. We need to hire people with the sustainability hats. All that comes with time. But at the same time, you can't wait. We had to go and execute on an investment plan that then said, we're buying businesses that recycle and vertically integrate. And now we have, we can get to up to 80-90% recycled component in there because we now own the whole vertical integration. We bought parts of businesses that were able to transform bioplastics and produce them and compound them. And so we've gone over a kind of 3 to 4 year period from blah, generic plastic business that probably doesn't have a future, to something that is extremely interesting. That, from a private equity perspective, that sits in a different valuation, just to talk financial numbers, because it's a completely different business, but also has a standing. We haven't finished the journey. We've just started that journey, but that now has a business that you can see where it's going to go for the next 10 years. And that's where the value is created.
Thank you, Serge. And I love that transformation and pivot story, because I think that is indeed one of the areas where private equity can play a really important role in helping companies make that pivot. Tazia, moving to you, if you could share with us, your firm, Closed Loop Partners' approach to this, creating ESG and sustainable value, shared value, and an example.
Sure. Well, this is going to sound like a good dovetail off of Serge, given that he touched on circular plastics. But Closed Loop Partners is both an innovation center and an asset management business dedicated to the circular economy and building the circular economy. In other words, transitioning away from the linear economy that is based on extraction of natural resources and disposal to one that keeps materials in play and self-incentivizes an economy that has net positive environmental, net positive social outcomes. A part of that is it must be profitable. In order for it to self-perpetuate, back to Serge's point, dollars and cents are the key to that. And so everything that we do at Closed Loop Partners is related to natural resource efficiency and supply chain optimization. From an ESG perspective, ESG from our lens, we've been impact investors since our founding in 2014. And ESG is really a lens by which you can mitigate risk. And really, as part of that, as Serge said, diligence process and underwriting. And so it's deeply embedded into our investment process. The impact piece is where there's that contributing and shareholder value of positive outcomes and that proactive measure. And so maybe a good example to bring this to life, taking a quick step back. So we invest across on our asset management platform within the PE space. We have venture capital funds, which are very early stage, seed and pre-seed investments before commercialization. We'll be launching a growth equity strategy this summer, the lower middle market buyout strategy, which I'll focus on here, given PE and control ownership. And then we have a catalytic vertical where we're provide flexible capital to accelerate these businesses faster than markets otherwise would. within the PE space, so within our buyout strategy, a good example here, again, really dovetails off of what Serge said, would be Balcones Resources. Our firm acquired Balcones in late 2019, and Balcones is a material recovery facility. So what Serge was describing in terms of his company, what is the input so that we don't need to go and extract new oil or virgin material to make the packaging that goes into Paul's old company, Unilever's packages of how we get our shampoo. And so, Serge, you mentioned recycled content. Well, we need to go get those materials, and recycling rates throughout North America are quite poor. Our firm is very focused on increasing those so that we can increase the amount and the quality of recycled materials. And Balcones is a best of breed company. We acquired the company when it was a $5 million EBITDA company, a family-owned business that our firm knew well. And we've grown that company over just the last 2.5 years. We've tripled EBITDA through organic and inorganic growth. And Balcones Resources is now the largest privately owned material recovery facility throughout the Southeast region, bookending from Texas to Florida, and really demonstrating to the market what it means to produce high quality recycled commodities that can then be inputs into new goods. So great example in terms of keeping materials in play. We track at our firm how we deliver that value in terms of those materials that are kept in play, the additionality we bring from reducing GHG emissions and those avoided, and then what that means for the value chain thereafter of those inputs.
Thank you so much, Tazia. And as you said, a great sort of segue from Serge's example. So Brandon, I think everyone is familiar with KKR, but they may not be as familiar with the work that you're doing around ESG and impact. So again, if you could share with us your approach and an example, that would be very helpful.
Absolutely. And those are tough acts to follow. But so this is something that we have really been doing for a long time. In 2008, we first formed an internal team to focus on ESG matters, and we partnered with the Environmental Defense Fund to create what we called our Green Portfolio Program. A year later, we became an early signatory to the UN-backed Principles for Responsible Investment. So just like Serge and Tazia said, we too view ESG and sustainable investing as really a core lever for how we can create value with our portfolio companies. So we view, just like they said, we view ESG issues as business issues and opportunities. So the way we approach it, we created a responsible investment policy that integrates ESG risks and opportunities into how we invest, and we have rolled that out globally and across all asset classes. And so that starts with pre-screening, kind of before we get to a formal diligence process, where we utilize gating issues to try to determine critical ESG concerns and whether we should move forward or not, quite frankly. Once we're into diligence, we use a materiality-based approach that calibrates to the industry in which that company is operating in, and we evaluate the ESG risks and opportunities using CSB standards. Of course, we review all this and discuss all this in our investment committee. But what's great is that it also primes us once we own a business. We're already primed to kind of go in with a game plan and a map. Serge kind of said, oftentimes there's something, but you need to do a lot more. And so we focus on measuring and managing environmental impacts. So we do a baseline, a GHG footprint assessment, set goals and objectives for the progress we can make, and do that both in our ownership period, but also set the stage for the future, just like they said. I was going to give a similar example. We invest in a company called Charter Next Generation that a lot of our thesis, we invested last year in partnership with Leonard Green Partners. A lot of our thesis is that they can drive sustainability, that they're well positioned to drive sustainability through their value chain, which is supplying high performance specialty films into packaging and other markets. But hearing that, to give a little diversity, I'm going to talk about a different company now. I'll talk about Ingersoll Rand, which is a business that we owned for a number of years. We finally exited our position last year. It started in 2013 as a company called Gardner Denver that we took private in July 2013. We grew the business. We took it public again in 2017. And then in early 2020, we merged Gardner Denver with Ingersoll Rand's industrial segment. I think it was a $15 billion combination. And so, kind of take it through the ESG framework. Start with environmental. For one of the fairly large parts of the business when we invested in it was a manufacturer of equipment to the upstream oil and gas sector. And so during our ownership, we sought to both improve the stewardship of that business, but then also exit it from the company. But we retained a minority stake to help make sure that the responsible framework that we had applied kind of continued with the business. We also set goals for a 60% reduction in greenhouse gas emissions by 2030 and net zero by 2050. But importantly, we also sought to see how we could improve how our products performed from an environmental perspective for our customers. So we also set a goal to reduce customer greenhouse gas emission impacts by at least 15% from our products by 2030. From a governance perspective, we appointed, governance and diversity. We appointed a Hispanic CEO who's now one of only 16 in the S&P 500. The leadership team that we built is around 30% gender diverse, and the board of directors that we built is about half, 50% diverse. From an employee perspective, when we first invested in Gardner Denver, there were about 6,000 employees of the business. We grew that to 16,000 by today, by the time we exited. But when we first came there, only 86 employees had an ownership stake in the business, or about 1% of those employees. Today, all 16,000 employees of the company are owners, and it's something we could talk more about. That equity that was granted to those 16,000 employees is today worth about $500 million, and that's to non-management employees, to hourly workers. You also tried to invest in the workforce, so we reduced the injury rate at the company by 70% during our ownership, and tried to drive employee engagement. So we did a baseline employee engagement survey initially where we scored at the 19th percentile, and by the time we had exited, our most recent scored at the 76th percentile. So, just like Serge and Tazia said, at KKR, we embed ESG really into everything that we do, and that's an example of it.
Thank you so much, Brandon. That's really helpful because it really walks through kind of how you identified the material ESG issues for the business and then managed for risks, but also looked at the opportunities in terms of creating new services, for example, for the company's clients. So thank you so much for that. So now we're going to turn to Christopher, who comes from the perspective of an institutional investor looking at where they're going to be placing their money. So a very important stakeholder for you all. So what requirements and internal resources do you have in place, Christopher, to ensure that your private equity investments do not contribute to problematic worker and societal outcomes, and that actually instead contribute, as we've heard, for positive social value in addition to profits?
Thank you, and it's good to be with all of you. It's that's a good question. Just as a bit of background, the Church Pension Fund is the pension plan that serves the clergy and lay employees of the Episcopal Church. And so as a faith-based institution, those are the kinds of questions we wrestle with all the time, which is sort of how do we support the values of the church in the context of the portfolios that we invest? And so issues around climate, issues around social justice, issues around diversity are front and center to the calculus in terms of our conversations with managers all the time. So in terms of how do we engage with managers, how do we talk with managers and funds on the subject, there are two areas where I would point to, and both have been referenced earlier. One is around impact. And so we have a discrete focus on investments that have a positive social impact. So using climate as the example, what are those investments that present climate solutions or solutions around climate change, whether it be energy solutions, sustainable agriculture, food, all of those themes are investments that we will consider on a discrete basis. Secondarily, there's been a good discussion around ESG. How do firms incorporate environmental, social, and governance issues into the context of the portfolios that they manage? And so in our conversations with managers, we expect a robust approach to considering ESG issues in investment analysis. We believe, and I'm glad Serge sort of focused on the long-term nature of an investment portfolio. As a pension plan, we are long-term in nature, and we believe that ESG issues do impact long-term value for the investments that we make. And so to us, talking with our managers around ESG issues creates alignment of time frame. That we focus on. I mean, we have long-term liabilities, and with those long-term liabilities, we're looking for long-term returns. And so ESG issues are an important lens through which we evaluate the investments that we make and the managers that make those investments on our behalf. One area where I would say we engage with managers is it's fairly easy to see through managers that aren't taking these issues seriously. I mean, obvious examples.
What are some signals of that, Christopher, so people know?
Yeah, well, I mean, for example, we had a firm come in who was very proud of their new ESG head of ESG, and she was very impressive, but she's in the marketing organization, and so if you're actually taking ESG seriously as an investment consideration, your head of ESG should not be in marketing. Your head of ESG needs to be part of the investment process. That would be one example. And then the other example I would give would be when we sit down and we talk about specific investments, where a manager may be involved in carbon intensive businesses. To what extent do they think about the risks associated with those businesses? How are they mitigating those risks? How are they thinking through those risks? And I mean, we use this as a lens, not only for how are they dealing with ESG, but also sort of the nature of their investment process overall. I mean, if they aren't taking carbon risk seriously where it's relevant, then where else are they missing material opportunities and risks? And so it's one lens of one way of assessing the overall strength of the managers in which we invest.
Great. Thank you so much, Chris. Very, very insightful. Brandon, I want to return to you. You started to talk a little bit about the work that KKR has been doing to increase employee ownership in portfolio companies. What are your plans to take this approach across all your investments? And, for others to understand, what are the barriers, right, to doing so? And how would you recommend other firms follow your approach?
It's a great question, and just for some context, as you alluded, we really believe in the power of a broad-based employee base with engaged employees. Because we think that sharing ownership in a company, beyond just being a nice thing for the employees, it also serves a really important aspect of our investing process in terms of how we drive performance. Because frankly, when we look at the traditional model without shared ownership, we think there are a lot of times where what management wants or what the shareholders want can be at odds actually with what is good for the hourly workforce. And so by sharing ownership with all of the employees of the company, we really try to break through that and get everybody on the same basis, so that when one constituent wins, everybody wins together and everybody shares in the value that's created at the company. So this kind of started out pretty simple for us, quite frankly, but we've learned over time and grown our approach and our toolkit. So now we have a fair amount of technology around it. And importantly, just talking about this, it's not just about employee ownership for us. We really want there to be a broader employee engagement paradigm to encapsulate within that. Because if it's just ownership, it can almost start to feel more just like compensation. So for us, we think of it in three pillars. One is all employee ownership. But then part and parcel with that, the second pillar would be employee engagement and worker voice. So I kind of alluded to that at the Ingersoll Rand example, but we want to do baseline and annual employee engagement surveys, implement the feedback, or at least some of the feedback that we get from employees, so they are heard and they have an influence on the business. And we also partner every company with a charity that's relevant to their communities, and the employees choose what charity that is. And the third pillar is financial inclusion. So we actually partner with nonprofits like Operation Hope that deliver financial literacy training to the hourly workforce. And we found is important to help prepare folks for that ultimate liquidity event, so that if it's helpful, they have an opportunity to learn more about personal savings and things like that. So this is something that we are, to your question, rolling out very widely at KKR. It kind of started initially at our industrials team, and for some years now, we've been increasingly broadening it. Now at our new America's Private Equity Fund, we're going to be applying this kind of across the board at pretty much all companies in that fund. And frankly, it's our hope that this is something that catches on broadly, that it's broadly adopted within other private equity firms and even outside of private equity. Actually, a public company, Harley-Davidson, recently implemented an all-employee ownership program that was informed by what we've figured out over time. So there really aren't a lot of barriers, to be honest with you. I mean, there are some cases where there are structural barriers. You need at least a certain level of profitability per employee for the numbers to work, because it needs to be amount that is meaningful to each employee. So there are some business models. Retail is kind of one of them, where there can just be too many employees and too much employee churn for this kind of a model to work. But those are exceptions and kind of not the norm. But for folks that are interested in doing this, we recommend that they get in touch with a nonprofit called Ownership Works, which is seeking to create standards for shared ownership and also common tools for implementation. So it's something that we and other private equity firms and other great institutions are kind of coming together to form as a sort of think tank for how to continue this movement more broadly.
Wonderful. Thank you so much, Brandon. So moving to you, Tazia, your focus on scaling the circular economy means investing in innovative technologies, which means that at times catalytic below market return capital is needed. But you also have to demonstrate that there are good market returns if the sector is to be viable. Can you share with us how you're approaching this challenge?
Sure. So important to note, as stated before, is we won't actually shift a system. We won't create that self-perpetuating feedback loop unless it's incentivized and rewarding from a profitability standpoint. So very important, and across our market rate strategies, we're always striving to be top quartile, top decile in our asset class. So where we might accelerate technologies through our private equity or venture capital investments on the market rate side also comes with what we call builder capital. So our firm is very much about both experienced investment and fund managers and bringing together in that team experienced operators, former CEOs, entrepreneurs, heads of municipal agencies, environmental engineers, people deeply familiar with actually operating into success. And so examples here, on a company or a couple examples that kind of illustrate how we do that and accelerate certain technologies through builder capital type of investing would be AMP Robotics is a good example. So AMP Robotics was a company that Closed Loop Partners through our Venture Fund 1 invested in. We met the founder, Matanya Horowitz, way back when he was graduating from Caltech. Now, what he had developed was an AI robot for the recycling industry. So one of the first AI sortation robots for the industry. And it was our firm who put the early money in and connected him throughout material recovery facilities where his robots could potentially be deployed. He iterated on what would be the optimal prototype and then ultimately has scaled his business. Following us came Sidewalk Labs came into the company. Sequoia led the Series A, and most recently XN led a Series B. And I think you can hear about AMP Robotics when you're hanging around Silicon Valley these days. But the point there is, we actually seconded an employee to AMP Robotics. We helped deliver strategic partnerships and customers and helped iterate in terms of designing those robots. And we're really proud and thrilled with how Matanya's grown his company. So there's a way of bringing builder capital into a clear market rate type of return and accelerating technology and innovation that increases the quality and quantity of recycled materials, back to those core impact KPIs that we have at our firm. Now, over on the catalytic side, and thanks for raising that, we have at our firm a vertical that is catalytic capital. And what we mean by that is flexibility, there to make capital stacks work and come in perhaps earlier, perhaps differently than mainstream or non-catalytic capital might, in order to get those feedback loops to shift faster. So let's give an example there. This is a great one because this is a very successful company from all measures of traditional profitability, a company called TemperPak, was introduced to us at Closed Loop Partners by the impact investment firm SJF. They were an equity investor. And Closed Loop Partners, through our Closed Loop Infrastructure Fund, where we make below market rate loans more flexible, we actually lent this early stage company below market rate venture financing, allowing them to build their facility where they could make their curbside recyclable packaging material. So TemperPak makes a curbside recyclable replacement for packaging in the cold chain. If you order something like Fresh Direct, next time take a peek and see if TemperPak is part of your box. So Closed Loop Partners, through the Closed Loop Infrastructure Fund, one of our catalytic strategies, lent TemperPak below market rate money, allowed them to not dilute themselves in terms of the founders and the other equity holders, allowed them to build their facility and scale faster. Today, Goldman just made a big investment into TemperPak. It's over $100 million top line business and scaling in a really, really impactful way, replacing materials that would otherwise be ending up in landfill or in our natural environment. So that's another good example of innovation accelerated more quickly than it otherwise, I'm sure, would have been. But now TemperPak is more successful faster.
Very exciting. Congratulations. I'm going to look in my next delivery. Thank you. Excuse me. So Serge, as you discussed a bit earlier, Investindustrial has been working with your portfolio companies to encourage the uptake of really embedding sustainability core to their business strategy and also tracking the return on sustainability investment. How have you been approaching that process? What's working? What's not working? Any advice for others about how to tackle this?
I'd probably split that answer into three sections. The first one is education, the second culture change, and the third hard numbers and tools. The first one around education, I mean, business schools have been notorious for decades for not teaching sustainability. So we have a whole suite of executives running businesses that have no clue, may have read about it, understand it, but don't know how to apply it. So one thing that we do, and this is free marketing for you now, Tansi, is we actually send a lot of people to NYU Stern CSB to take that course, about 25 people a year from within our investment teams. Anyone who starts at Investindustrial within 3 months is shipped virtually to New York to take that course. And then coming to what you were saying, Christopher, earlier, we never allow the head of marketing to take the course. It's CEO, CFO, CPO. It's somebody who's in the business who will make an impact. And incredibly, we, after the first year, they call us back again and say, can we send another 2-3 people, please, to the course the following year? And the answer is generally always yes. So first of all, we start with education. People need to understand where's the value from that. And we had some very funny conversations recently. We have a whole suite of people that just finished the course recently, and one of them said, "I was the biggest cynic in this. I went in saying, thinking, what a bunch of hippies. Why am I doing the sustainability course?" And they came out completely evangelized on ESG. I mean, it's incredible how that person is speaking at the board in the with the investee companies and pushing that agenda. It's wow. The second part, I'm going to skip culture change and I'll come back to that, is actually the tools and how do you present that case. I mean, we use Rosie. We've bastardized Rosie into a pre-investment phase where we're trying to understand and build an investment thesis that has a budget and an allocation. We've got very frustrated with external advisors who still use the lens of risk. And, the liability is X million. And like, okay, and where's the opportunity? I've literally blackballed some commercial due diligence providers saying, if you don't think outside the box, it's not MBA 101. You guys are paid to think, where's the future, how it's going to go. I need to know what's the opportunity. It needs to be baked into the business plan. And without that, we're not able to get to that transition. So that's the first part to it. The second part to it is we collect a huge amount of information and we manage by data. We're numbers people. That's how we work. We collect about 400 ESG KPIs on an annual basis from our companies. It's a lot, but we actually manage with those KPIs. We do about 70 on a quarterly basis, and that gets fed into a mini Rosie mechanism. It flows, it starts working. And as soon as we get that first round of numbers with a company who have no idea what they're doing on ESG, we go straight into developing sustainability strategy bespoke to them with initiatives and line items on budgets and so on. And immediately the conversation goes into who's owning each initiatives and project, who has that budget for it, and how much of their variable pay is going to be linked to it. And we got to a point, actually, we were just finishing an exercise with a company in Italy recently, and the CEO said, instead of having variable KPIs, we're going to make it the same that we do with EBITDA. If we don't hit all of our ESG targets, we won't even talk with anybody about variable pay. And now they're talking about exit, and they want us to renegotiate their portion if the exit is successful, including ESG into it. So that now gets us into culture change, right? We've exited 2 companies last year, and I caught up with them, the management team in various events, and they said, having gone through that process for 2-3 years, our new owners are surprised by how we're running this. One of them got acquired by an industrial, and they're actually doing a reverse process. They're teaching their owner about embedding some of that ESG culture that they came in with, which is, for me, great success in terms of them getting into that at the end. And then finally, we then use the standard ROSI methodology that Tazia and the team at CSB have developed, where we're measuring, we're trying to link intangibles with tangibles and make that number. But it all has to start with, you have good, reliable data, you have a good thesis that you're following, and then that will all flow from it. There's nothing more than a head of sustainability or head of procurement saying, I've done those 10 ESG things, and here's the impact that I've delivered to the business, and I know I'm going to get an extra 10% on my bonus at the end of the year. It becomes an auto kind of moving machine, and it's incredible how that progresses. And ultimately, for me, it's you get the education in place, you embed the tools, the processes that they can then manage, and then you'll see the culture change at the end.
Thank you, Serge. So moving to you, Christopher, as you're reviewing your investment manager choices, your PE firm choices, how are you looking at the performance of the firms on, in particular, climate and human capital issues as sort of 2 of the really high-profile issues today? Do you get sufficient information? You alluded to this a little bit earlier. And particularly, what would you like to see improve? What kind of change do you want to see in a sector?
Well, in terms of the information that we're getting, I think it is scattered. We get a range of different information from different providers in their sustainability reports or in their regular reporting. And I guess what I would like to see is a bit more consistency, although it's really, really challenging to provide a consistent framework for impact reporting. What we have struggled with is how to sort of define the impact of our own portfolio. And so what we do is we take the underlying sustainability reports and try to build an aggregate measure for how the fund itself is generating impact. But for the most part, and I don't like the idea of just doing storytelling, but sometimes we revert to storytelling where we don't necessarily have an aggregate number for what the portfolio is doing, but what are component parts of the portfolio where we're doing well, and what are component parts where actually we need to address issues with managers. So, for example, on human rights and human capital, one of the concerns that we have been debating extensively over the last month are issues around human rights that manifest itself in Russia. But then so many companies that we're working with are saying, well, what's happened in Russia is unprecedented, but it's not, right? And so one of the things that we're thinking about is how do we actively engage with our managers around human rights issues, knowing that the issues that we're seeing in Russia are not unprecedented and that these issues are global. So it causes us to take a finer look, for example, at our exposure in China. What are we doing in China? What are we doing in other conflict zones? And how are the managers that we're working with dealing with these issues? And so, again, it's more around what are the themes that we're working with and how are managers reporting on these themes, and how are managers, are the investment firms and the investment funds taking these issues very seriously?
That's very helpful. Thank you, Christopher. And let me ask one last lightning round and ask you all to just be very succinct with sort of a 1-minute answer, which is going to be tough because it's a big question. And I'm going to start with you, Chris. So, and again, because you, I think, alluded to this, to the war and sort of how we deal with that. So as we look at, as the world makes commitments to both net zero, but also struggles with this conflict's impact on energy availability and on price, in the background of this, we're seeing some private equity firms increasing their investments in fossil fuels and dirty assets. We're seeing public companies spin off some of those dirty assets to PE, where it's less visible and less accountable, right? Mm-hmm. So how can the private equity industry in general hold itself accountable to commit to funding the energy transition and exiting dirty assets? How does the industry accelerate the glide path, particularly given that there's some nice money to be made in sticking to these dirty assets?
Yeah, well, I mean, there will be a glide path, and we hope that glide path is speedy toward a lower carbon economy. And so that is our hope. What we do is we work with our managers to understand what the speed of that glide path is, and we encourage them to properly reflect the risks in the investments that they're making. And I think that too often we underestimate the risks associated with the dirty assets. And so we will challenge the managers to more effectively quantify what are those risks and how they're mitigating them. And ideally, in that process, they will reduce their use of the dirty assets and move us faster toward a clean economy. But then we will also encourage positive impact investments on solutions to climate as well. Thank you.
Brandon, 1 minute or less.
Well, I lost 5 seconds looking to unmute. At KKR, we really focus on investing in renewable energy while also supporting the companies that are in our portfolio to decarbonize over time. So we think that as you teed up, that technology and commercial realities mean that it's important for us to invest in renewable energy. We've invested in wind and solar and help to fund and drive progress and increase prevalence and affordability of alternative energy. But we also believe that it's important to be good stewards of conventional energy. Because even under the most aggressive carbon reduction scenarios, as we're seeing now, conventional energy will still be an important source globally for energy for some time to come. So we have a hybrid approach in our private equity funds. We don't invest in any energy assets. We've carved that out. But we do have an energy real assets fund at KKR, and we emphasize improved ESG practices and progress. And so we think that being a responsible operator through the transition, by doing that, we can create better outcomes than just selling those assets to somebody else who may not share the same focus and values we have on ESG considerations.
So Thank you, Brandon. I'm going to move on just because we have 2 minutes. Serge?
It's a balance between energy security, sustainability, and economics. We are a carbon neutral fund. We have SBT sets at the fund level, and therefore our companies have been doing that. We've put a mandate a decade and a half ago to reach 100% renewables. So if I look at the energy conversation, companies were struggling and fighting with me. Oh, why are we doing 10-year renewable PPAs or investing in this because the payback is 10 years or whatever? The guys who did it back then are laughing their way to the bank today, and the others are all scrambling. And my whole team is firefighting, trying to make that happen as soon as possible. So I think one doesn't negate the other. I'll go back to what Brandon has said, which is, you need to have an investment thesis around fossil and that there is a role to play in transition. And we still need fossils for chemicals, and chemicals is everywhere. Yes, there will be a transition even on chemicals, but fundamentally, don't burn it. It's more valuable to do something else with it.
Thank you so much, Serge. Tazia, you have the last word.
Well, I think everybody did a great job. We need to be focused on the structural shift, and we can't abandon that as energy prices rise. We need to not let the system hide behind energy equity. We need to make sure that we are pricing in externalities and moving incentives to keep this shift going, regardless of the fact that we may be transitioning out of fossil fuels over time. The big flag I would put out there, I don't think that the folks on this phone are going to be the ones that we need to worry about. We need to make sure that there's transparency and accountability within the system so that people don't try to hide behind a status quo and we continue our shift. And I think it's people like Christopher who are going to hold us all accountable.
Great. Thank you so much, Tazia. Thank you so much to this panel. Thank you for the great work that you're doing and the transparency you're bringing to your work. Appreciate you working with us. I'm going to now turn it over to Allison Berg, who is our MC, and the next session will actually be on decarbonization as well. Goodbye, everybody.